they were asking to determine the post-merger earning per share. So to get the post-merger earning per share, to compute the post-merger earning per share, because this time they have given you a different offer price. A difference offer price is given as 40 shillings. So that will require you to calculate the new offer price. It requires you to compute the new offer price. So we are on the Roman letter 2. We are on the Roman letter 2, where we compute the minimum offer price, where we compute the new offer price. So to calculate the new offer price is supposed to be given by offer price. It is supposed to be given by the, you want to compute the offer price. Sorry, the exchange ratio, sorry. To compute the exchange ratio, to calculate the exchange ratio, it is supposed to be given by the offer price. It's supposed to be given by the offer price. Then we divide by what is supposed to be the market price per share of the predator. Market price per share of the predator. The market price per share of the predator. So they have given you a new offer price in the Roman letter 2 of the question. It is 40. So you take the 40, divide by the market price per share of the predator, which was given as 50. So get that particular exchange ratio, come up with that particular exchange ratio. Sorry, 4:5. So it is 4:2. So the predator will be giving 4 shares in order to acquire 5 shares of the target. So from that point, we get the new shares to be issued. New shares be issued. So to get the new shares to be issued, because for the 4 shares, you get 5 shares. So we want to know the target is Rocker Limited. Rocker has got how many number of ordinary shares? Rocker has got 2 million ordinary shares. It has got 2 million ordinary shares. So how many new shares should be issued? How many new shares should be issued? 1 point. Exactly 1.6. So this one will be 1.6 million shares. So we want to get the earning per share of the predator. We want to get the earning per share of the predator. So to calculate the post-acquisition earning per share of the predator. It is supposed to be given by the combined earnings of the predator and the target. The combined earnings of the predator and the target. The combined earnings of the predator and the target. Then we divide by number of the ordinary shares of the predator. Number of the ordinary shares of the predator. Number of the ordinary shares of the predator. Then we add number of the new shares to be issued. New shares issued. We add new shares to be issued. So combined earnings are the net earnings. You just add them together. The combined earnings are the net earnings. So Chilulu, it is 30 millions. You take 30 millions. Then for Roca, it is 2 millions. Sorry, it is 12 millions. Then you divide by the number of the ordinary shares for Chilulu are 6 millions. Are meant to be 6 millions. Then we add the number of the new shares to be issued as 1 million. Seven. 5 point. So 5.5 shillings per share. So the millions will cancel off. So after that, that is now our Roman letter 2. We now go to the Roman letter 3. We now check what is there as the Roman letter 3. So Roman letter 3, they said that using the results obtained in seeing Roman letter 3 above, and assuming that Chilulu's limited price earning ratio will remain unchanged after the merger, determine the post-acquisition market price per share. So the concept is the price earning ratio. The concept there should be the price earning ratio. When it comes to the price earning ratio, when it comes to the price, and because it will remain unchanged. So to get the price earning ratio, so first, the concept is the price earning ratio. It is supposed to be given by market price per share divided by the earnings per share. So the question had already given you market price per share for the data. So Chilulu had a market price per share of how much? Then we calculated the earning per share, which was earning per share for Chilulu. We got. So it will be able to give you 10 times the price earning ratio. But now the question wants you to get the market price per share after the merger. So from this equation, we make that market price per share to be the subject, because the question has asked you to calculate the post-merger market price per share of the predator. The reason being, they have said that assuming that the Roman letter 2 above, assuming that Chilulu's limited price earning ratio will remain unchanged, before and after will remain unchanged. So the same price earning ratio we have calculated will still be the same after that. So if I make market price per share to be the subject after the merger, so that will be the same as post-acquisition market price per share of the predator, you simply take, now I'm making this to be the subject. So if I make the market price per share to be the subject, you simply multiply the price earning ratio by the earning per share. So it will be the price earning ratio, So this earning per share should be the one after the merger. So also multiplied by the post-acquisition or merger. Post-acquisition earning per share of the predator, So that one was 10. The post-acquisition earning per share of the predator is 5.5. 5.3. 5.53. Yeah, so now you multiply. So that will be now the post-merger market price per share of the predator. The post-merger market price per share of the predator. Post-merger market price per share of the predator. So I advise you, if the one for the target, you simply take the one for the predator multiplied by the exchange ratio. So now we have done how many questions on the mergers and acquisition? So we have done, are they 4? Or 5? We have done how many questions? Yeah, so that will assist you now for the revision for the mergers and acquisition. So I had also given you the notes, the handouts. Yeah, so go through them and see what we can get from there. So now we start a new topic as restructuring and reorganization. We now start a new topic as the restructuring and reorganization. Structuring and reorganization. Now go to restructuring and reorganization. So we now go to restructuring and reorganization. So I gave you the notes for that. Online, are there some notes that were sent to the class group on the restructuring and reorganization? Online, you confirm to me whether there were some notes that were sent to you on the restructuring and the reorganization. The class group. So if, yeah, so those who are online, they are saying they can see the notes. Those who are online, they are saying they could see the notes. So you want to go to the restructuring and reorganization. So someone is asking how to show to get the exchange ratio using the AB. One AB, then C. Your function. Yeah. So I don't have a particular example in mind, but what do you do like this one? The first question. The first question, exchange ratio, just in your exercise book. Just want to find your kwanza. So the first question we did to get the exchange ratio, it was 45 divided by what? 60. It was 45 divided by 60. So what do you do? Just take 45 divided by 60, then you get the answer for that. Once you get the answer, then you press the sign ABC like that. There's someone who asks, when you take 45 divided by 60, it's not fair value. So you press equal sign. You press equal sign. You shall press your equal sign. Go to your calculator. There is this function. You can see this function on your calculator. Then press the function and get the answer again. When you press it, what do you get from there? 3 is. Now, that is what will be now 3:4, like that. So, are you okay at that point? So, that is now about the issue to do the mergers and acquisition. So let us now start a new topic, which is restructuring and reorganization. The restructuring and reorganization. So when it comes to restructuring and reorganization, then when it comes to the restructuring and the reorganization, they were also able to say that so the starting part is restructuring, where they were saying that it is the process of changing the capital structure of the company. It is the process of changing the capital structure of the company, and it is carried out as part of the corporate restructuring. So corporate restructuring is as a result of changes in the capital structure, operations, changes in the core business activities, and also changes in the assets of the company and the changes of the management team in order to improve the value of the company and enhance the shareholders' returns So that's what we mean by restructuring. So corporate restructuring is categorized into 3 as follows. There is financial restructuring, portfolio restructuring, and organizational restructuring. So when you start with the financial restructuring, they have given you several information on that. It is where the capital structure of the company is changed, and it is normally carried out by companies which are facing financial problems. I've given you reasons for the financial restructuring. There are also the terms of financial restructuring skills. So I want you to read them in that portion. Then after that, I've also explained to you what we mean by business reorganization. What we mean by the business reorganization. So there is also objective of the reorganization, then also types of the business reorganization. So that handout is that small, but most of the questions they test you on that in the theory part, they will be coming from that small handout. So I wish you get time, you read them in details, because we may not get time to go back on them. I will simply quote some questions from your past papers in relation to that. I will simply quote some questions in your past papers in relation to that. So if you can be able to refer if you go to the sitting of December 2021, the read exam, December 2021, when you check the exams for December 2021, there is a question number 3. There is a question number 3. There is a question number 3. So that question 3, starting with the part A, part A says that different companies have varied aims and timings for undertaking corporate restructuring. However, the single common objective in every restructuring exercise is to minimize the disadvantage and maximize the advantages. So comment on the above statement, highlighting 5 reasons for undertaking the corporate restructuring. So you just pick any. There is those which I've given you for the financial restructuring. Financial restructuring is still part of the corporate restructuring. You can see the reasons. Like now, I've given you to reduce the debts of the company to the manageable level. There is also the one to stabilize the company so that investors will inject new capital. You see all those. Yeah, you just pick any, or even those ones which I've given you as objectives of reorganization. Or maybe you can just explain up there. So anyway, that is now how you should have been able to go about to explain the same. But now when you go to part B, where they have asked you to distinguish between the following terms in relation to the corporate restructuring and what? Reorganization. So those terms, the merger and the spin-off, there is management buyout, management buy-in, and bundling, and also the capital reorganization. Also the capital reorganization. So all of them are there in that small handout, starting with when you go to page, if you go to page 3, you can see page 3 under mergers and demergers. Kuna mahali tunaandika hiyo those terms. Are you able to see the mergers and the demerger? So they have said that a merger is where companies which are equally strong combine or come together. Strong combine or come together. That's to be combined or come together, not combined together, in order to share a new business, which will improve their financial position. But the merger, it is where that's now where the question is coming from. The merger is simply where the company is now split into 2 or more separate business entities. So its aim is to create a new business entity which will enhance the value of the original company. That's now what we mean by the merger. I've also given you reasons for the merger. Then down there, you can see the spin-off. Yeah, so read those terms. Read those terms. When you go to Roman letter 2, management buyout and management buy-in, they are also given you on page 4. When you go to page 4, I've given you all that. Then they have also talked there about organizational restructuring or reorganization. So I would like you to just go through that small handout. It will be able to assist you when it comes to the theory part. So I want us now to have a brief subtopic in your exercise book. So under the restructuring and the reorganization, we can have a brief subtopic. So this topic is restructuring and reorganization in your book. But I want us to have a brief subtopic after that. So the computation part, you are going to do it in your book. But the theory I've summarized on that small handout. So we can now have a subtopic as valuation of securities and business. We can have a brief subtopic as valuation of the securities and business. Valuation of the securities and business. valuation of the securities and business. So when it comes to valuation of the securities and the business, so we can write there something brief by noting that securities in this case will be the ordinary shares. Securities in this case will be ordinary shares. Securities in this case will be the ordinary shares. And they are classified. Into two categories. They are classified into two categories for the purpose of valuation. They are classified into two categories for the purpose of valuation. They are classified into two categories for the purpose of valuation. So those purposes, we can now be able to see them in terms of, so we already know about cost of capital. We saw how to get the cost of the ordinary share. So we are simply going back. So the first one will be zero dividend, ordinary shares, ordinary shares. So the first one will be zero dividend growth rate ordinary shares. So under that, we write that the theoretical value of the share, will be expressed as follows. The theoretical value of the share will be expressed as follows. The theoretical value of the share will be expressed as follows. So if you could be able to remember how to get, so this one, if you recall the other time, KE was supposed to be given by D. So KE was the cost of the ordinary share. So it was the dividend, then we were dividing by PO. So this time we are looking at the value. We are simply looking at the value. So making PO to be the subject will simply be given by D divided by KE like that. So you just make this one to be the subject. PO is the value of the share. So making the value of the share to be the subject, now it will be D divided by KE. So this is now the value for that ordinary share, just in case they ask you to get, but in most of the cases, that one is not there. Then we go to number two. Number two should be constant dividend. Constant dividend growth rate ordinary shares. Growth rate ordinary shares. So constant dividend growth rate ordinary shares. The constant dividend growth rate ordinary shares. So even when you check the other side, so I'm simply making PO to be the subject. So this one will be given by DO in the brackets of 1 plus G. Then we shall be required to divide by KE minus G. KE minus G, which is the same as D1 divided by KE minus G. So we know DO is the last dividend that was paid. Then D1 was the next dividend to be paid. This KE is the cost of the ordinary share. Then G is the constant growth rate. G is the constant growth rate. So we know that we did something about the breakpoint. So remember when you are calculating the cost of capital, when you are, this one was the subject. So now when we make PO to be the subject, we just come to that portion. So this is for the constant dividend growth rate ordinary share. Tumesema how many categories? So they are supposed to be 3, sorry. They are supposed to be 3. So the last one would be non-constant dividend. Non-constant dividend growth rate, ordinary shares. Non-constant dividend growth rate, ordinary shares. Non-constant dividend growth rate, ordinary shares. So for that, we write that in this case, the value of the share will be expressed as follows. The value of the share will be expressed as follows. The value of the share will be expressed as follows. Value of the share will be expressed as follows. So now to get the value of the share is the same as PO. So it will be present value of the future benefits during non-constant period. Then we also add the present value of the future benefits. During the constant period. So we just add them in that order to see how we shall be able to come up with the value of the farm. So now after that, after knowing those particular how to get the value of the share, we can now also have a brief subtopic as valuation of business. Valuation of the business, because it was valuation of securities and business. So we can now have valuation of the business. We can now look at the valuation of the business. So under that, we note that the value of the business will be equal to the present value of all the cash flows. Will be equal to the present value of all the cash flows to be generated from the business, So that is now how we shall do it. But first, let us also have a brief subtopic as the impact of financial restructuring. We can now have the impact of the financial restructuring. The impact of the financial restructuring. So under the impact of the financial restructuring, we can summarize that the impact of the change in the capital structure, as a result of the financial reconstruction, can be determined by can be determined by A will be change in the growth rate. A will be the change in the growth rate. A will be change in the growth rate. Then B will be change in the share price. So B should be the change in the share price. Then C will be change in the risk. C will be now the change in the risk. Change in the risk. So let us start with the change in the growth rate. Start with the one for the change in the growth rate. Change in the growth rate. So when it comes to the change in the growth rate, we note that this is determined by computing the growth rate. This is determined by computing the growth rate, in the dividends, in order to assess the performance of the company, So I want to pick some questions in your past papers which have got those details. So the first question should be November 2018. November 2018, question number 3, part A. November 2018, question number 3, part A. November 2018, question number 3, part A. Check November 2018, question number 3, part A. So are you able to see November 2018, question 3, part A? So that question reads that the following are the summarized financial statements as at 31st December 2015 to 31st December 2017. So they are given you income statement for the year ended 31st December. So there is 2015, 2016 and 2017. The question has given you the turnover, operating profits, interest, profit before the tax, also taxation, profit after tax, and also the proposed what? Dividends, and also the retained profits. So the statement of the financial position as at 31st December 2017 has been given. You can see non-current assets, current assets, also financed by ordinary share capital, reserves, 10% long-term debentures, and also the short-term debts. When you go to the next page, they were able to give you some information about additional information. Note number 1. The stock market analysts expect post-tax earnings and a dividend to grow at a rate of what percent? 25% per annum for the next 3 years. Thereafter, annual growth rate will revert to the company's growth rate and remain constant each year to perpetuity. Note number 2, the overall beta is given as 0.8. Then beta factor for equity is 0.75. Risk-free rate is given as 12%. Market return is 28%. The current market price of the ordinary share is 67.70 come dividend. The debenture price is 89.50, which is X interest. Then they gave you the corporate tax rate of what percent? 30%. So now required Roman letter 1. Evaluate whether the share is currently overvalued or undervalued by the market forces. So then Roman letter 2, advise the prospective investor whether to buy the ordinary shares. So that's now the question in that particular portion, because it has a constant dividend growth rate ordinary share, then it will change. But now the information is in the note number 1. You can see our note 1. They have said that the stock market analysts expect that the pre-tax earnings and the dividend to grow at a rate of what percent? 25% per annum for the next 3 years. Thereafter, the annual growth rate will revert back to the company's growth rate and remain constant each year up to perpetuity. So it is the category number 3 of the ordinary share. You have written it in your notes. You can see in your notes the one for the non-constant dividend growth rate ordinary share. So in that case, to get the value of the share, to compute the value of the share, when you want to calculate the value of the share, so value of the share, value of the share, value of the share, which is the same as VO, will be equal to present value of the future benefits, present value of the future benefits, during non-constant, then we add the present value of the future benefits, present value of the future benefits, during the constant period, So the question in the note number 1 has said that stock market analysts expect the post-tax earnings and the dividend to grow at a rate of 25% per annum for the next 3 years. But thereafter, annual growth rate will revert back to the company's growth rate and remain constant in each year up to perpetuity. So that growth rate has not been given. You need to compute. I gave you 2 methods of how to calculate the growth rate. There was the compounding method and retention ratio method. When you go back to your notes on how you are calculating the cost of capital in order to get the weighted marginal cost of capital, I gave you 2 methods of calculating the growth rate. So for this question, it is the compounding method. Using the compounding method, we use the compounding method to get the growth rate. Using the compounding method, so that we get the growth rate, because it was not given. So G is supposed to be given by N, then DN divided by DO, then you minus 1. So G is supposed to be equal to N, DN divided by DO, then we minus 1 at that portion. We minus 1 at that level. So I want you to go back to the question. So 2015 is DO. You name them like that. You see 2015 will be DO. 2016 will be D1. 2017 will be what? D2. Yeah, so the first one is period 0. We agree on that. Yeah, so that means that our G, it will be 2, N is 2, then D2 divided by D4, then you minus 1 like that. We agree on that, that the first one is period 0. So if the first one is 2015 is 0, so 2016 will be 1, 2017 will be 2. So that means that our N, that's why N is coming to 2. So another thing is that we need to get D2. So D2 is the dividend per share in the year 2017. D2 is the dividend per share in the year 2017. So that question, we need to calculate some few items there. First, let us get the number of the ordinary shares. Let us first get the number of the ordinary shares. Number of the ordinary shares. So to calculate the number of the ordinary shares, are you able to see under financed by? Are you able to see in the question under the financed by? Ordinary share capital, in brackets, the bar value is what? 20. When it is 20, how much is the total value? So take 30 millions, divide by 20. That should be able to give you the number of the ordinary shares. 1.5 million. So it will give you 1.5 million ordinary shares. So we are computing D2. D2 is the dividend per share for the year 2017. So the question had given you dividends declared and paid. Are you able to see in the income statement proposed dividends for 2017? Are you able to see those dividends? They have given you 3 million because there are 3 zeros at the top. There are 3 zeros at the top. So dividend per share for 2017, take the dividend proposed, which is 3 million, divide by the number of the ordinary shares, which are 1.5 millions, which are meant to be 1.5 millions. So you simply take the dividends declared and which were proposed, divide by the number of the ordinary shares. So this one will give us which one? It will give us 2. Then DO is dividend per share in the year 2015. Our dividend per share in the year 2015, you also go back to the question. Are you able to see the proposed dividend for the year 2015? They have given you which figure? They have given us, that is the same as 2.1 millions. So 2.1 millions divided by also 1.5 millions, because the number of the ordinary shares are not changing. So that one will give you which figure? 1.4. So it's exactly 1.4. So after that, now we come to this point to get our G. So it is 2. So D2 is 2. DO is 1.4. Then you subtract 1 like that. So get that constant growth rate. Nakuja ngapi? 0.195. When you express it as a percentage, online you are getting which figure? $19.52. Yeah, so it should be 19.52 as a percentage. 19.52 as a percentage. So once we have done that, we now compute. We should now be able to compute the present value of the future benefits. Now compute present value of the future benefits. Of the future benefits during the non-constant period. During non-constant period. Non-constant period. So we now start off with present value of the future benefits during non-constant period. The present value of the future benefits during the non-constant period. So we shall be having the year, then dividend per share, then present value interest factor. The present value interest factor, the present value interest factor, the present value interest factor. Present value interest factor. So we need to come up with that particular cost of capital. Sorry, just a minute. So we need to get the present value, the present value for the future benefits during the non-constant period. So we have said that we shall be having the year, dividend per share, so present value interest factor. So this one is normally the cost of capital in the period end, so that we get the present value for that. But the cost of capital should be the cost of equity. the cost of capital should be the cost of equity, which has not been given. You need to calculate. So you can leave at a small space. We do the working for the cost of capital. Maybe you can just do somewhere up there. It's not long. Using CAPEM. You remember CAPEM? So to get the cost of equity, cost of capital, we use CAPEM. You remember the risk-free rate plus expected return for the market minus the risk-free rate. Then the beta factor for equity. So risk-free rate was given to you. So just leave a space of around 4 lines. Then you calculate this after you have written that. You can leave a space of 4 lines before you do that working. So risk-free rate was given to you in the note number 3. You can see note 3. They gave us what? They had given you 8. Then expected return of the market in the note number 4. They gave you which figure? 14%. Then you still minus 8. So this normally beta factor of equity. I'm using the other question, sorry. So when you check the note number 3, risk-free rate has been given as 12. The risk-free rate is given as 12. Then expected return for the market is 28. We also subtract 12. But the beta factor for equity, are you able to see in the note number 2? We use the overall, the beta of equity. So the overall beta is 0.8, but the beta for equity is 0.75. We are on the equity. So that should be able to give you the discounting rate. We saw this formula under the risk-adjusted discounting rate to get the discounting rate. So it will give you which percent? 24%. Yeah, so we should be using 24% each year. 24% for each year, so that we get the present value like this. So we start off with the year 1. So year 1 is the same as 2018. Year 1, when you check the note number 1, they had said that the stock market analysts expect that post-tax earnings and the dividends to grow at a rate of 25% per annum for the next how many years? 3 years. So our year 1 is the same as the year of 2018. So we increase the dividend of 2017 to get the one for 2018. So dividend for 2017, we calculated, we got which figure? Dividend per share for 2017. So you take the 2 shillings, increase it by 25%. You can see the note number 1. Dividend were to grow at a rate of 25% per annum for the next 3 years. So increase it by 25%, not by 0.25, so that you get the dividend per share in year 1. 2 points. You are getting 2.5. Then when it comes to year 2, you also take 2.5, also increase it by 25% to get the one for year 2. Because the growth rate was 25% for the first 3 years. So that one should give you which year? Sorry? 3.125. Then year 3, you also take 3.125. You also increase it by the same 25%. 0.90625. So now I want you to check in the table. What is 24% in year 1? 0.8065. How about year 2? 6504. And the next one should be 0. What? 5245. Yeah, so those figures are from the table. When you check 24% in the first table, you will get these figures. So multiply this by these figures, you get these values. Then you add them together. So take 2.5, multiply 0.8065, get that. This multiply that, you get a value, also this by that. So add them together. That now will give you the present value of the future benefits during the non-constant period. You get the present value of the future benefits during so that is now during the non-constant, but there is also the one for the constant. We add present value of the future benefits during the constant. So this one is for the non-constant. So the other part should be present value of the future benefits. Of the future benefits. Of the future benefits during the constant period. During constant. So we also calculate present value of the future benefits during constant period. So during the constant period, we use this formula. PO is supposed to be given by DO in the brackets of 1 plus G. We divide by KE minus G. So during the constant, it is DO in the brackets of 1 plus G divided by KE minus G. So you see this particular DO. DO should be the dividend for, because it is supposed to be equal to D1. This one is the same as D1 divided by KE minus what? Minus G. So our DO is the dividend in year 3. Our DO is the dividend in year 3. You see the one that will now be year 4. Our D1 is year 4 because the growth rate was 25% for the first 3 years. But thereafter it stabilized at the company's growth rate up to infinity. So thereafter it is starting from year 4 onwards. So year 0 will be now year 3. So this PO is also coming in year 3. So you should convert them to period 0. So converting them to period 0, discount them. discount them at the present value interest factor, 24% in year 3, because 0 is the same as year 3. 0 is the same as year 3. So we come at this particular point. So GO is the dividend per share in year 3, which you got 3.965. But now 1 plus G. G is the historical growth rate. You can see in the note number 1, they say that the growth rate was 25% for the next 3 years. Thereafter, the annual growth rate will revert back to the company's growth rate and remain constant in each year to perpetuity. Your figure to recalculate. You remember the 19 point what? It was 19.52%. That was now the growth rate for the company. So it was 19 point, which is the same as 0.1952, like that. So we divide by KE minus G. KE minus G. So KE is this cost of capital, which is what percent? 24%. So that is the same as, so KE is the same as, also 24% is the same as 0.24. We also subtract 0.1952. But we have said that you need to convert them to period 0 by multiplying by 12.24%. That figure was there, 0.5245. So we get now the value for that. So once you have done that, you now add the two figures during the non-constant plus during the constant to get the value of the share. So now to get the value of the share, you simply add present value of the future benefits during the constant. You simply add present value of the future benefits during the constant, and constant plus the 1 for the constant. So value of the share, value of the share. So what was there during the non-constant? You calculated. You can round them off. It is 6 point what? 8 like that. Na hii mnapata ngapi? 54.66. So when you add them together, what should be the value of that share? 60.76 like that. So that should be our Roman letter 1. That is meant to be your Roman letter 1. You want to comment whether it is share is currently overvalued or undervalued. So we compare that with the current market price per share. current market price per share. So the current market price per share was given in the note number 5. The current market price of the ordinary share is how much? But it is come dividend. We subtract the dividend on it to get X dividend. We normally use X dividend. So you calculated dividend per share in the year 2017. You remember the dividend per share in the year 2017? You remember that you calculated dividend per share in the year 2017. It was how much? So you subtract 2 so that we get current market price, which is X dividend. Come dividend means it has included dividend. We always use the X dividend. So when you minus the dividend, we get up 65.7. So we are comparing the two to show whether the share is overvalued or undervalued. We want to know whether the share is overvalued or undervalued. So the determinant is the market. The determinant is the market. So the market has given it 65.7. But the true value is 16. So that share is overvalued by the market forces. So the share is overvalued by the market forces. So the comment will be that the share is overvalued by the market forces. The share is overvalued by the market forces. So when it is overvalued, we should not buy in the Roman letter 2. So Roman letter 2, they were asking you to advise the prospective investor whether to buy the ordinary share. So the investor should not buy the share. Should not buy the share. So the market has given this. When you go to buy in the market, we pay 65, isn't it? But the true value is 60. So you end up getting a capital loss. You will end up getting a capital loss. So that share should not be purchased, because when you go to the stock exchange market, it is quoted at 65. But it is true value. It is how much? 60. So when the share is overvalued, don't buy the share. You will incur a capital loss. You will incur a capital loss because you buy it at 65, then in your books, you have recorded it at how much? At 60. So you incur a capital loss. But if it is undervalued, you get a capital gain. So if it is undervalued, you are normally advised to buy, because you will do what? You will get a capital gain. So that is now the comment that you are meant to give in relation to the Roman letter 2. So our next question is supposed to be May 2019. May 2019, question number 5, part B. May 2019, question number 5, part B. Our next question is meant to be May 2019, question number 5, part B. May 2019, question number 5, part B. So that question 5, part B for May 2019, they said that Excellent Limited is considering acquiring Best Limited. Then they have said that the firm in the industry, in order to consolidate its market share price. So Best Limited has been less profitable, so it has paid an average of only 20% in the taxes during the last several years. In addition, it has used little debt, having a debt ratio of 25%. Having a debt ratio of 25%. If the acquisition will be implemented, Excellent Limited will operate Best Limited as a separate wholly owned subsidiary. So this will increase Excellent Limited gearing ratio to what percent? 40%. So the following is the forecasted financial data for Best Limited over the next 5 years. So they have given you year 1, 2, 3, 4, and 5. So that will be during the non-constant. That one will be during the non-constant. Then additional information, note number 1. The risk-free rate of return is 8%, and the debt is considered to be risk-free. Expected return of the market portfolio is 13%. The firm's levered equity beta after acquisition is 0.8. So after 5 years, you see that statement. After 5 years, the net cash flows of Best Limited shall increase at a constant rate of what percent? 6% per annum in perpetuity. So that one will be now during the constant. But year 1 up to year 5, it is non-constant, because when you prepare the cash flow statement, each year will be having different cash flows. That's why it will be non-constant. But from year 6 up to infinity, it will be the constant. Then, note number 6. The firm's gross profit margin is what percent? 40%. Then the Best Limited incur a fixed financing cost of 2 million per annum. The firm's equity shares and the bonds are currently trading at what? At par. So this question will be, you are looking at the value of the share. But this one, we are looking at the firm value that determine the maximum price payable to acquire Best Limited. So we are looking at the value of the firm. The price to pay is the same as the value for the company. The price to pay will be the same as the value for the company. So you will be adding present value of the future benefits during the non-constant, plus the present value of the future benefit during what? The constant. So another challenge in the question is that this is a company. The other one was the share, the value for the share. But this one, they want to get the value of the company, the price to pay to acquire the company. So now our cost of capital will not be the cost of equity. It will be the weighted average cost of capital, where we combine both equity and debt. The other one was the value of one share, but this one is the value for the company. So the company has both equity and debt. So for that reason, we need to get the cost of capital first. You need to get the cost of capital. You need to come up with the cost of capital. So we are calculating the value for the company, not the value of the share. So to get the value of the company, the cost of capital will be WSCC. The cost of capital will be WSCC. So WSCC, we take the weight of equity, cost of equity for the delivered firm. Weight of the debt, KD, must always be after the tax. KD must always be after the tax. Then KEL, we did this under the capital structure theories. We know how to get KEL. It will be the risk-free rate plus, in brackets, expected return for the market minus the risk-free rate. Then the beta factor of equity for the delivered firm. The beta factor of equity for the delivered firm. So risk-free rate in the note number 1. We have been given the value of 8. Then expected return of the market in the note number 2. They gave us which figure? 13. Then we also minus 8. So equity beta was given to you in the note number 3. The firm's levered equity beta after acquisition is estimated to be 0.8. So multiplied by 0.8. We get 12. So we are computing the WSC. So wait for equity. The wait for equity, I want you to go to the second paragraph. You can see the second paragraph. Are you able to see our second paragraph? They say that Best Limited is less profitable, so it has paid an average of only what percent? 20% in the tax during the last financial. In addition, it used little debt, having a debt ratio of what percent? So when the debt is 25%, equity must be 75%. So the weight, this weight for equity will be 0.75 multiplied by cost of equity is 12, like that. Then the weight for the debt is 0.25. So KD is normally the cost of the debt. KD is normally the cost of the debt. But in the note number 1, they had said that risk-free rate is what percent? 8%. And the debt is considered to be what? Risk-free. So if the debt is risk-free, it means the cost of the debt is the same as the risk-free rate. When the debt is risk-free, it means that the cost of the debt is the same as the risk-free rate. It means the debt is risk, the cost of the debt is will be the risk-free rate. So our risk-free rate is what percent? 8. But you see up there, it must be after what? After tax. So multiplied by 0.7. The tax rate is 30%. So 1 minus 0.3 is what is giving me 0.7. So that you get now our WSC. We get our WSC. Get our WSC. So our WSC will be the discounting rate. Our WSC will be the discounting rate. So after that, we should prepare the cash flow statement, whereby our time is not sufficient. So what we do, we shall just stop there. When we meet, we shall now be able to finish that question. So Mwalimu is meeting those guys for a far. Okay, so I will plan the other way. Yeah, but what is remaining is not something like this one. I should be able to finish it in the next lesson. The one for the restructuring and reorganization. Then after that, there are some small topics. Replacement, which I should do also in 1 lesson and a half. Then long-term decisions, like now bond refinancing. There is the adjusted net present value and the lease. Those ones, we should be able to combine them within at least 4 lessons. Then after that, there is the financial derivatives, which is remaining. So financial derivatives should also take you at least 4 lessons. So 4 lessons are like now when we have 3 lessons in a week. So we normally have alternate. Yeah, when I meet you for the Sundays. So in a week, we should have finished the financial derivative. If I meet you the 2 lessons, then on Sunday, we combine at least we have 2 or 3 hours. So we should be able to finish by the time we're going for the exam. What I have covered all the key topics, the comprehensive one, the long ones, we have finished. What is remaining are small topics, which can be done in 1 lesson or 2 lessons. Then we move. So we shall stop there when we meet. We shall be able to see whether we finish this topic, we start something more. But for the theory, make sure that you read the handouts, isn't it? Yeah, so we can stop there for now. When we meet, we shall now be able to finish off the question. We can now stop there for now.